So first I cover the last week's stocks which we traded. Some we traded and some we did not, but I have covered. And then next would be dividend and its effect. So as I have mentioned before, there are certain patterns which professionals follow, and I always try to understand what the professionals are doing when they are coming in and how they are coming in to make money. So I need to follow their style or their pattern when they are coming in. So if I know when they come in, I need to just follow them. So fortune is made by mastering few techniques. So there's so many patterns, so many techniques people employ, but we don't have to master all the techniques. Some are low risk and high reward. Some techniques occur only few times in a month. So we need to find those which are occurring quite often, and when you find the entry based on that technique, then the return is higher and faster. So fast and high return, and it's reliable, so and consistency. So master the techniques which produces high and fast return. The money making strategy, there are many. I'm mentioning few. There are many which I follow, and I'm mentioning few. One of the two I like, or these three, is a breakout. So when the stock is breaking out, I identify that stock and get in. Or the stock is breaking down. So breakout or breaking down, or my stock has pulled back and now is breaking out with the force. So breakout reversal strategy. The third one is opening range breakout, which means the stock, when the stock market open in the morning, the stock is trading in a certain range, and then it breaks out, either goes up or go down. So I monitor that. I have certain things in the trade session, and I know when the stock is making its move and when it's not. So based on the time frame I set, 15 minutes, you can set 30 minutes, or half hour, 1 hour. So opening range breakout. So I think I have few charts. I'll show you what I mean. So when you see that, and you'll say, yeah, it makes sense. So these are my favorites: gap up, gap down, gap up reversal, gap down reversal. So when the stock gaps up and it makes its continuation move, we can go long. Gap down, when it gaps down, it continues to go down. So I'll show you some chart. Gap up reversal, meaning the stock gaps up and then it comes down, hits some resistance. So stock, when it gapped up, it hits some resistance, and then the seller comes in and they sell. So that's what happens. And gap down reversal, the stock gaps down always to the support, and the support could be 50-day moving average, 200-day moving average. These are common. The common gaps are 50-day moving average and 200-day moving average. Your low risk entry is when the stock holds like 200-day moving average. If it gaps down at 200-day simple moving average and it stays there like for a half an hour, then you know chances are that it will stay there. It doesn't mean that the stock will suddenly rise upward and you start making money. It just means that you have a low risk entry, and usually buying the shares work better than buying the option, because for option you need the momentum behind. So for shares, if the stock gaps down at 200-day moving average and the low is not far from 200-day, way below, because then that's your stop, then you can just buy like a starter position. So that's gap down reversal. So here's the MU chart. We traded MU puts. MU has been flying, and here I think it was an earning move. So if you see this candle tried I mean, this candle from this support tried to rise, but next day this was the reversal. So when I saw this reversal, the chances are higher. So in the trading, I always say, okay, what are my chances? The chances are higher that the stock will come down than the chances of the stock going up, and there is a momentum behind. So when I see that, and then I look at the option, so I say, okay, the options also are reasonable, and you know, I need to just get in. The volume is there, open interest is there, the spread is not wide, so I need to get in. And then I say, okay, here's the exit, right? So here's the, at 33 is the exit. So if you enter somewhere here near 32, 31, 33 is the exit, and then next day it fell. So my target was 28, and I think let me see, no. So my target was 28, and I think it came at 28.77. So when it came at 28.77 and your target is 28, you need to get out. So we got out with profit. Next is LYB. This trade we got out, I think it almost break even. You see this resistance line? So it hit this resistance and it was coming down with force. So, but the volume was not that high. But anyway, we bought puts, and the next day it did not fall. It stayed at this level, so we got out. So this was the pattern. I mean, there's no indicator here. No indicator. This, boom. Next one. So there is no perfect indicator in swing, at least in swing trading. There's no perfect indicator. By the time the indicators lined up, the move is over. The indicators are always behind. So you have to see these patterns, learn these patterns, and then go for it. There's no indicators are lagging indicators. Now this one, SPG. So it's the same pattern. So when I saw this SPG chart, right? So we traded puts. This was resistance. How many times it tried to break this 165 and it failed. So if the stock is coming down like this, chances are it will come down. Why I would think it will go up? It didn't go up here, it didn't go up here, it didn't go up here, it didn't go up here. 4 times it tried, 5th time it came down. If the stock fails 3 times or more, at certain point, chances are it will fail. So that's the criteria, 3 times or more. So 1, 2, 3, 4, it kept on failing. So the chances are high that it's going to come down. It's not going to go up. So we bought the puts, and next day we got out at this candle. So I got out because the volume was low, and I said, okay, we take our profit. So we made money. So this was the move which was happening. You cannot hesitate. If you hesitate and you say, okay, let me see what it will do and all that, you will buy at the low, so you won't make any money. You have to, when you see this move, like break up this candle, white candle, you need to just get in, knowing that, okay, here is your exit. So I do this line. Here is your, if it's reversing, then it will break 165. So if it break 165, you change your position, right? You go with the call, and then here's your exit. But it didn't break. So we, in swing trading, we're looking for that quick move. The move you are expecting happens, we get in. Sometimes I stay in the trade and that doesn't work. Sometimes we get big money, and sometimes we give back the profit. So singles are the objective, not the home run. Home run comes, that takes care of a loser trade. So it increase the batting average. So home run comes once in a while. Now this one we did not trade, but I have it on radar, COG. So if you see how many tops it is putting on. So it doesn't matter 1 top, 2 top, 3 top, 4 tops, 5 tops, as long as there is a word top. If the top is there, it means heavy resistance. Chances are high that it will fail and it will come down. So I have it on radar and I want to show you. So COG is on radar. and it's related to oil and gas. So if we see the down move, furious down move coming down, the stock is, then we can get in. And here's the exit, 23.45. So about from 25 to $20.50, probably will make 30-40% on options. So if happen. If not, then you will be wrong if it breaks 25.50. This line has to break. Next, this LB trade. Now look at this LB trade. So LB gap down on earnings, right? So it was early morning shot I took of LB screenshot. So look at this, 48.54, right? And look at this volume. There's no volume here. It's all very tiny volume, and it was coming down. It gapped down. So now this one is the gap down trade I do. So I was watching it for continuation to the down move, and then when it, based on the gap down thing I have, it gave me the confirmation that okay, it's gonna come down and I should buy puts. So I bought puts and I sent alert, and next same day is on 22nd of, is it 6th of July, right? 9:52 a.m. So 9:52 a.m. 6th of July is 9:52 is Eastern time. So market opens 22-minute. I spotted LB, and then look at what happened. Same day, it came to 46.49, and the volume rose, right? So we got out. So we made good money, because when the stock gaps down on negative day, who knows who will come and start buying. So we got out. We made money and got out. But I had it on radar. Next day, I was watching on Friday morning what it will do. So on Friday morning, as soon as the market opened, there were some buyers. They come in and they came in, started buying like little shares, and it went up 20, 30, 40, 50 cents, and then it failed. So when it failed, it reversed, and as soon as it reversed, I was watching for the low to break. So if the low is breaking, the chances are high. If the low of the previous gap down is breaking, the stock will continue going down, and the volume was high. So the original target was 44. So that was my target. And next day, because this gap, you see, so the stocks, now let me explain this gap. So the stock gaps down here on April, found this support, and then gaps up. So here is your bullish entry. When the stock gaps down and then gaps up, why it gapped up? This is confirmed bullish signal. So whenever you see this pattern, you go with it. Gaps down, gap up, or gap up, gap down. If the stock gaps up and gap down, it's a bearish entry. If the stock gaps down and gap up, it's a bullish entry. So this stock needed to fill this gap here and then here. So this was my target here. So I knew that okay, it can come down. So I was watching, and then on Friday, as soon as it broke the low or about to break, I sent another alert to buy puts, and then look at what happened. This slide, I have a 6-month mastering the coaching program. So if you're interested, you can send me email, and we can book the appointment and talk for 40 minutes, and I can explain to you about the program. I will start soon, and there are already students registered, and so you can send me email at this motion at financialmarketwizard.com. Now let me go back to what happened to, let me see. Okay, I think I missed the chart. So next day on Friday, LB went down further, came close to I think 45, 44, and so we got out and we made money again on the puts. So the point is, if the stock gaps down, follow or apply the gap down strategy, opening range breakout strategy, breakdown strategy, and then go with it. And if it, for next day, if it starts to go down, then you can get in because the volume is high. This is UAL chart. So I spotted UAL. I did not trade, did not send alert. The market was bearish, and I saw UAL was moving. So this, you see the UAL support. Airline stocks were moving on Thursday and Friday. American Airline and United Airline. So you see this support, and then this is the next day move. So I think I spotted here, but I did not get in because of the market bearish, and we had other trades. And then look at it, UL moved up, and when the one airline is moving up, then you see the other airline, the most common one. So if the other airlines also start moving, then you get in, then you know something is going on with that sector. The next one is AOI. This one I spotted on Friday, and I sent alert to end of day service. I did not buy. It was breaking out. So look at this. So this was the support, and the volume was low, but the entry is, chances are high that it will go up. And one member, Kevin, he sent me email saying, should we buy AOI? So I told him yes, you can buy shares. Options were kind of wide. So look at what happened, AOI. It moved up further, so it's breaking out. So here is your stop, 60. So it's going up, and the volume was good. Now ADSK. So ADSK also spotted here and did not get in. Again, the market was bearish, but then I got in here, ADSK. So if it breaks this resistance line, it's going up. Another thing, there's a white space here. You see this white space? So trend line, this is the resistance line, and there's nothing here. So this white space, so the stock can travel up. There is some resistance at this level around 115. So 110, 115, we need to monitor. For swing trading, the exit is somewhere here, but if it breaks, it can go up. So we just follow this line. Toll. Now, the reason I'm mentioning toll, DHI first came DHI to my radar. So I didn't buy builders. I did not buy. Then I saw Toll Brothers. I said, okay, let me capture this. So the home builder stocks are moving. DHI, Toll, and PHM. These three were the ones I spotted. So something going on with the home builder stocks. They are breaking out, going up. You see, similar charts. DHI has a better chart. X. So we have been trading X calls and puts. So again, this Friday, early, as soon as market opened, like it was 2 minute, 3 minute, I saw this down move. So early at night, I have seen X, and when I saw the fast move down, I bought puts and I sent the alert. And I wanted this 50-day to break, but it looked like it held. So I got out with profit. Bought it like $1, $1.10, and $1.35 exit. So this was a quick move in 1 hour. And another reason I got out, because LB was getting ready. So I was watching LB on the side. So this, we exited with profit and got in with LB and exited with LB. So if another trade is building up and I'm in one trade profit in 1 hour, 2 hours, we need to get out and make money, lock the gain. This one is RH. So this came on Friday. Something was going on. It dropped big on Friday, but then it held the 62.40 level. So if RH breaks down below 62.40, around 62, then it would be bearish. So something was going on with this. The signal is not confirmed yet because it bounced off, so it can go up. So if on Monday, if it breaks this level, then it can come down easily at 55, 85. So that's put candidate. Okay, for those who are not members, swing option service, its regular price is 127. You can try out for 17, and if you like, continue. It's 117 per month. So I'll give the link later, and you can receive the email also. So let me open, I think this was the last slide. Let me open the, yeah, the next webinar will be on July 16th, Sunday, next Sunday. And let's discuss dividend. So let me close this and open dividend screen. Okay, so dividend. Now this can be boring. I don't know. If you are bored, you can go get some tacos. So dividend and its effect on option prices and strikes. So this topic I'm teaching like first time. So, and there are a lot of things in it. So these are the topics which we'll cover. About 60% of it I will cover today, and then the 40% I will cover next. And we will go through these topics which we cover today. We will go again next Sunday. So if you missed, you can cover next Sunday. So what is dividend? So the definition of dividend is a distribution of a portion of a company's earning to the shareholders. So when the company make money, they distribute. They have two options: keep it and invest it in some future projects for their growth, or pile up the cash like Apple do, or give all to shareholders or portion of it to shareholders. Keep some and distribute some. So to make shareholders happy. Usually the dividends are given by those companies which are not, they lack growth, so they became mature, so now they want to make the shareholders happy, so they start giving dividend, and they don't know where to put the money to invest or do with it. So the treatment of companies' profit. So they can retain profit for reinvestment and growth purposes. They don't give out any dividend or distribute to shareholders a dividend. They make $100, they give out $100 to the shareholders. Or they give some, keep some. So there are three choices. There are three types of dividend: cash dividend, stock dividend, property dividend. So I'll explain one by one. Cash dividend is the dividend where they say, okay, if you hold per share, we will give out like 10 cents. So if you have one share, you will get 10 cents every quarter. So every quarter they declare dividend, you get 10 cents, 12 cents, 13 cents. The stock dividend is you hold 100 shares and they declare 5% stock dividend, so you receive another 5 shares. So your share increases. Suddenly you, instead of having 100 shares, now you have 105 shares. The property dividend is when they don't have cash and they don't want to distribute the stock or dilute their the outstanding shares, they give out some dividend in the form of like inventory, or they have some assets. They say, okay, we will sell this asset, and whatever cash we will get from this asset, we will distribute it. So the companies don't do this. Some do. So they lack cash and they want to make shareholders happy. So understanding the cash dividend. So let's say the stock is XYZ and is trading at $10, and they declare 5% cash dividend. So whatever dividend they declare was 5%. So the cash you receive is 5%. But what happens usually if the dividend is a surprise higher than the normal, the stock drops next day. On the ex-dividend date, the stock drops. So the stock would drop easily by 5%. So from $10 it can go to $9.52. So people buy stocks and for dividend purposes and appreciation purposes. They keep getting the dividend and the stock keeps going back up. So appreciation on the stock is happening and they are getting the regular income. So that's the two purpose. So benefits of cash dividend is regular income. So you buy 1,000 shares and they declare dividend, you can make 7-8% per year. So that's the return you get, and the stock is also appreciating. So your capital is also increasing, and you're getting 7-8% dividend. So, and then it depends before tax and after tax. So there are three components of cash dividend. So you have to understand three components then you can evaluate which company is better in dividend, so you can invest properly, make the investment decision. So dividend amount, dividend yield, and dividend payout ratio. So these are the three. The first one is very simple, dividend amount. So a dividend amount is a dollar amount per share company pays to its shareholder. So for instance, they can say, okay, we will give you $2 per share. The stock is trading at $100, and they say, okay, if you hold one share, you get $2. So that's your income. So that's the dividend amount. The dividend yield, the definition of dividend yield is a financial ratio that indicates how much a company pays out in dividends each year relative to its share price. So whatever dividend they are giving, you compare it with the share price, and that's the percentage. That will tell you the dividend yield. So let me give you an example. This is the formula of a dividend yield. So to calculate the dividend yield, you need to know the annual dividends per share. So for instance, if the company is paying $2 dividend per quarter, and let's assume it's the same every quarter, so that's $8 dividend, right, per share. And the price of the share, just assume at the end of the year, is $100. So if you want to calculate the rough dividend yield, you can say $8 divided by 100 is 8%. So dividend yield means you're getting 8% return on your money. So annual dividends per share divided by current price per share and take it as a percentage. So your return is 8%. So that's the dividend yield. So return on your investment. So now when you're comparing two stocks side by side, besides other factors, the fundamentals and the stability of the company and the growth, etc. If you're just looking at from the point of view of dividend yields, then you have to prepare an Excel worksheet, and then you say, okay, this one is better, or this one is better. So for instance, suppose the stock, one is ABC stock, the price is $20, and they give annual dividends of $1 per share. There's another stock, XYZ, the price is $40, and they give $1 per share dividend. So which company is better from the point of view of dividend yield? So if you take the formula, dividend yield, so you take the dividend, annual dividend divided by 20, this one is 5% yield. The XYZ, $1, and the price is $40, you get only 2.5% return. So actually, in simple words, you're saying return on your investment. So return on your investment is greater on ABC because you're putting less money and getting the same dividend. You're putting double the money and you're getting the same dividend. But you have to see the appreciation. Who knows, the $20 stock goes to $10. So what's the point of having dividend? And this $40 stock goes to $80. So which one is better? So do not just look at dividend yield. You have to see many other things. $20 stock can go to 10, $40 stock can go to 80. So when you are estimating the dividend yield, then you just take the last quarterly yield. So because the company declares dividend on a quarterly basis, so you just find out what dividend yield they declared, what was the dividend yield last 4 quarters, then you just multiply by 4 and divide by the current share price. So your dividend could be $2, then $1.90, then $1.80, then $2.20. So you take the average of yield and divide by current share price. So So that's your estimated dividend yield. Now the real dividend yield. So this scenario I explained is before and after tax. So again, you have to know your tax brackets. What is your federal tax rate? What is your state tax rate? And whether you will be investing the dividend back or you are taking it as a cash. So for income purposes, all that it comes into the calculation. So you can sit down and do the calculation, and I give you one example. So the example is the current share price is suppose $100. You purchase 1,000 shares. Total invested $100,000. Average quarterly dividend is $2 per share. So every quarter they declare $2 per share. Suppose you held this stock for 12 months. Your federal tax rate is 15%, state tax rate is 20%. I'm just taking this arbitrary example so you can plug in. And you're assuming that whatever dividend you get, you reinvest it. So you buy the shares back with that amount. So reinvestment rate is 100, so you're not getting any cash. You're just reinvesting it. So it could be a little off, this calculations, and I will work on it again, but to give you the example, I think it's correct, but and show you why. So dividends, you receive $2,000 per quarter. You invested 100,000, you're receiving $2,000. Dividends earned in 1 year is more than $8,000 because the assumption is that you are reinvesting your $2,000. You're buying more shares. So when the stock declares dividend and gives the dividend, the stock price falls. You can buy more shares. So based on that, your dividend is not, your income is not 8,000. It goes to 11,500. But then you pay tax. So 35% tax. Your actual dividend amount will be around 7,500. So if you take this amount, then the dividend yield before tax comes to 11.53%, but after tax it's come to 7.5%. So this is the difference of the tax. Now next concept is dividend payout ratio. So dividend payout ratio means that if I make $100 and out of $100 I give you $80 profit, that's 80% payout ratio. If I give you all 100 in the form of dividend, then means I'm giving the payout ratio is 100. So you have to know this also. So what is their payout ratio? Some companies give out whole amount as dividend, some keep half they invest. So you have to know what is their trend, long-term trend is. Are they consistent? If they are not consistent, then you will get surprised. So sometimes they give 80% of the dividend have a payout ratio. Sometimes they drop to 20%. So they are not consistent. So if they are not consistent, then you don't know what will happen. So you have to know their long-term trend of the payout ratio. So this is another point you have to remember. So the dividend payout ratio is the amount of dividends paid to stockholders relative to the amount of total net income. So in other words, same thing. The company makes $100. If they give out $80 as profit and $20 they keep, their payout ratio is 80%. So you can calculate the dividend payout through this formula. Dividend payout is dividends divided by net income. So total amount of dividend divided by total income they earn. Another formula is yearly dividend per share. So you can take the dividend per share and divide by earning per share. So it's the same thing. So whatever shares they have outstanding, you can divide the net income by the earnings, by the shares, you get earning per share. Then you take yearly dividend per share. So whatever formula you use, total dividend amount divided by total income, or dividend per share, then earning per share. So you get the payout ratio. Now, I did the research and they say that the payout ratio between 55% to 75% is good payout ratio. So if they make 100, they give you 55. They distribute the income, 55% of that dividend amount, income amount, they give out as a dividend, and 75% is also good. So 55 to 75% is a good amount of dividend. So what does dividend payout tell us? So if they give you 55% and keep 45, so they are putting some money in their reinvestment growth project, and they're giving out some to you. So how much return to shareholder and how much reinvestment in growth? So by looking at dividend payout ratio, you can immediately find out how much they return to shareholder and how much they reinvest in growth. And then you have to look at the long-term trend. It should not be fluctuating high. Sometimes they give out too much dividend and sometimes they don't. So when they don't give you dividend and you are relying on the dividend as part of your income, you may get surprised. So interpreting the dividend payout ratio, you have to see the company maturity. So the new growth oriented company, they usually don't give out dividend. They want to keep all the shares income to reinvest in their growth. The older company, they give the dividend on a regular basis. So if you're looking for high dividend payout ratio, you look for more mature company, blue chips. The dividend sustainability, so you're not you have to see if they are consistent in their dividend, so they are not giving you surprises, so not fluctuating, and whether their payout ratio is high or middle of the rate, middle of the road payout. So is it way high, like 80-90%, and if they are doing it at 80, 90, 100%, then one quarter they can, anything below that 80, 90, 100% is surprise for you. And their long-term trend, so you have to evaluate their long-term trend. What is their payout ratio? So negative dividend, sometimes there's a payout ratio negative. So the company, let's say the company is giving out dividend on a regular basis, and then one quarter they had setback and they didn't make any money, but they are giving out the dividend because they don't want to hurt the shareholders' feelings, right? So if they don't give out the dividend, maybe they will have a sell-off. So in order to protect the stock's price, they either give the dividend from the existing cash or they raise cash. So this is usually a bad sign. So if one quarter they don't even have any cash to give, they didn't earn enough, and they are using the existing cash or selling something to give you the dividend, so it's a bad sign. So you have to look for that. So it's called negative dividend payout ratio because there was no earning, negative earning, loss. Okay, so what to watch in dividends? So I did some research, and they say that when the company paying high dividend and they are buying back their shares also, it's not a good sign. So they are trying to prop up their stock price. So look out for those companies which are paying very high dividend and they are buying their shares back. So you have to do your due diligence. Last thing I think is the market sentiment effect. So if you have stocks and you're expecting dividends, for instance, of 50 cents per share, and they declare 5 cents per share, the stock will drop. So this is what's expected. The stock will drop because from 50 cents they went to 5 cents per share. People will sell and they will go somewhere else. If they usually declare 50 cents per share dividend and suddenly they declare 60 cents per share, the stock, this has a positive sentiment effect. The stock price will rise. So any surprise to the upside in dividend, usually the stock moves up. If the surprise is to the downside, the stock drops. Okay, so what happens on ex-dividend date? So let's say tomorrow is the dividend distribution. So if you hold shares today, you will get the dividend tomorrow. So tomorrow, when they is the called ex-dividend date. So it doesn't matter if you buy the stock, you won't get the dividend. The person who already has the dividend, stocks registered in their name, they will get the dividend. So if you are long, suppose you bought today, tomorrow is the ex-dividend date, you will receive cash. If you are short, you have to pay out the cash because you borrowed the stock. So you borrowed the stock, you have to give out the cash. So you have to be careful. You have to see if the dividend is coming. And you're holding short, you have to pay out the cash. And the stock price usually falls by the dividend amount. So if you will see on the ex-dividend date, the stock suddenly falls, and then later it recovers, but that day it falls. On ex-dividend date, falls by the dividend amount. So if you're holding calls, your call premium will go down. If you're holding puts, your puts premium will go up. So this is a long topic, and then there are too many, so I will cover this next Sunday, the topic whether you treat the dividend as income or treat the dividend as reinvestment. And then there are other topics like a stock dividend, a property dividend, whether you exercise options or you don't exercise, you sell the stock or don't sell the stock. So all this I will cover next Sunday because it's already 45 minutes. So thank you for coming, and let me see if I have any question. And if not, so those who are new, they will receive email with that first that $70 offer and $17 offer, and you can join the swing option service. Thank you. I don't see any questions here. Thank you. Bye.